I'm really excited today because we have our friends and partners with Putnam, and they are going to touch on the rising rates and how stable value investments may offer liquidity, stability, and consistency in unstable markets. So we have the Putnam Portfolio Manager, Stephen Horner, Investment Director Kevin Calabro presenting. But first, I'd like to introduce Stacy Zenger, who is the Senior Key Account Manager with Putnam.
Great. Thanks, Leah. And thanks to all of you for spending your time and the next 45 minutes or so with the Putnam Stable Value team. We appreciate you investing in this webinar. As Leah said, we're happy to be here. I am joined by Steve Horner and Kevin Calabro, who I'll introduce in a few moments. But before we dig into the meat of the webinar, I did want to share some comments about Putnam and our stable value strategy and how we partner with the RPAG network before we get started. In our commitment to offering innovative solutions to serve retirement plan needs, Putnam is proud to continue our partnership with RPAG. First, we offered our investment advisory services for the large cap value CIT. And most recently, we launched the stable value strategy as an exclusive CIT option for RPAG advisors. Our discussion today, as Leah mentioned, will focus on the topic of stable value. At Putnam, we manage over $15 billion of stable value assets. Liquidity, stability, and consistency are essential to our process. Liquidity is a primary consideration, and it's provided through a structured cash flow, which does offer us the ability to operate our put in a flexible manner. We'll talk about that today. We believe in diversification and do take the opportunity to invest within the full stable value universe. So we invest in cash alternatives, traditional GICs, and managed synthetics. We'll talk about that as well today. Overall, Putnam Stable Value has produced strong results with an above average net crediting rate and consistent long-term performance over a variety of market cycles. To expand your stable value analysis capabilities and take a deeper dive into our strategies, or even compare it to other cash equivalent options, remember that the Stable Value Analyzer tool is integrated within the RPAG Advisor portal. This is a tool that allows you to create custom reports. The Stable Value Fit analysis allows RPAG members to filter stable value data such as crediting rate, market to book ratio, credit quality. This tool is a great complement to all of the systems and the resources that are offered to you by RPAG. That's a tool that will be managed and supported by the RPAG support team if you need more information on that. And of course, we're happy to answer here at Putnam any questions about the stable value strategy itself. At Putnam, we do take a proactive approach to managing volatility and pursuing superior results. And with the Federal Reserve's planned interest rate hikes for 2022 likely to have a wide-ranging impact on fixed income assets, we're here today to share our thoughts on rising rates and how stable value may offer the liquidity, stability, and consistency that your retirement plan clients are looking for. As mentioned, my name is Stacy Zenger. I'm a Senior Key Account Manager with the Putnam DCIO team. I am supported by a team of external and internal wholesalers. We have 6 external wholesalers at Putnam dedicated to the DCIO space to help you with whatever you may need. And I encourage you to connect with those folks moving forward. I am joined today on the call by Steve Horner, Portfolio Manager of Putnam Stable Value Funds. Steve has led the strategy for nearly 20 years. I'm also joined by Kevin Calabro, Fixed Income Investment Director with Putnam Investments. With that, I do want to pass the call to Kevin. He's going to set up a conversation with Steve about our stable value strategy and the current market environment. Kevin, all yours.
Great. Thanks so much, Stacy, and thanks everyone for your time today and your continued partnership. Really appreciate you all giving us the opportunity to provide an update. And I think this update is really timely given what's happening in the fixed income market so far this year. So we'll start the conversation by just providing a high-level overview of what's happening within the fixed income markets today. And then we'll dig deeper specifically into stable value and how the current market environment's impacting different types of stable value investments. We'll talk about some key risks within stable value we think is very important at this period of time, given the market environment. And we'll also talk a little bit deeper into how our fund is structured, particularly in this market environment. So with that, Steve, clearly the first four and a half months of the year have been extremely challenging for all investors, right? The market has been driven by two major themes. First, changing monetary policy expectations to stem stubbornly, high inflation in the US. And then secondly, rising geopolitical tensions. So with that, can you just start by giving us an update on what's happening within the fixed income markets?
Yeah, you're right, Kevin. It's been a very difficult environment for really all assets, not just equities. Every fixed income sector, including treasuries, has suffered losses this year. And as you point out, there are several reasons for the situation that we're in now. First, markets are adjusting to a very new Fed regime, which includes aggressive rate hikes and a reduction in the Fed balance sheet known as quantitative tightening, or QT for short. Both of these policy changes are in response to the historical inflation prints that we've been seeing, as the Fed is committed to bringing those figures back down in line with their 2% long-term inflation goal. So as the bond market digests this new rate path, it's actually responded quite violently, pricing in upwards of 200 basis points of Fed interest rate increases for 2022. This has not surprisingly caused some distress in virtually all bond sectors, regardless of credit quality. And a few examples of year-to-date sector index returns through Friday, May 12th, show the broader Treasury index down roughly 8.8%, the broader investment grade corporate index down 13.4%, the mortgage index down 8%, and the commercial mortgage index down around 7.7%. If you look at benchmarks that are used within stable value funds, the intermediate aggregate from Barclays is down roughly 7%, and the little bit longer in duration aggregate benchmark is down almost 10%. As you mentioned, secondly, there's been some geopolitical issues that are going on in the world that have affected markets as well. Obviously, the conflict in Ukraine has certainly increased uncertainty with respect to global growth and specific commodity markets, oil and natural gas being the main ones. This has really accelerated a risk-off mode, as the outcome there remains quite unclear. Additionally, Russia's future plans also remain uncertain, as there's some fear that Ukraine might be the first of several conflicts that they take on, as Putin tries to reestablish some territorial control enjoyed by the Soviet Empire during the Cold War. The situation there remains very fluid with little visibility, and this is always a negative for risk in markets. And finally, the other thing that's affected markets so far is the continued economic impact of COVID shutdown policies, particularly in China. These have really resulted in very little improvement in many of the supply chain issues experienced since the outset of the pandemic that we're all familiar with. And as a result, this has caused corporate earnings projections to be slashed, leading to reductions in US and world growth estimates. Really, in the simplest of all terms, there really hasn't been a lot of good news out there for markets, nor has there been a lot of places to hide from the volatility.
No, thanks for that overview. Clearly it's been a challenging market environment so far this year. So now that we've laid out the broader fixed income backdrop, can you talk about how rising interest rates specifically impact the different types of investment options within a stable value strategy? And when I think about the different types of investment options, I think about first cash. I also think about traditional GICs, guaranteed investment contracts, and also synthetic GICs or wrapped bond strategies, right? A fixed income portfolio with one or multiple wrap providers that are providing the book value protection for the underlying participant. So it'd be great if you could comment on, how the impact across the different investment types have affected key metrics for stable value funds, such as the market to book ratios and crediting rates as well.
Yeah, it's a really great question, as clearly we're now in an environment that is frankly new to many stable value professionals. If there has been a bright spot this year, it is that stable value funds have continued to perform relatively well so far in 2022. As these funds are designed to smooth volatile market returns over time, as you mentioned through the crediting rate formula, we've seen very little change in crediting rates since the end of last year. As an example, our fund specifically has fallen just 3 basis points in gross crediting rate. However, as you point out, there are many different strategies that are used in these products, and some of them have struggled more than others. Specifically, wrapped bond strategies, as the underlying assets in these products have felt the brunt of the rate rise in terms of negative absolute performance, something that we have not seen in quite some time. This has resulted in market to book ratios on funds falling below 100% for the first time since early 2018. The speed of the rate rise since January 1st, as an example, 5-year rates are up almost 170 basis points from January 1st, also means that some of these losses have not yet been reflected in current crediting rates, as most funds reset their rates quarterly. So this reflection, assuming no change in rate direction from where we are today, is something that we should see play out over the balance of this year. This is something that we refer to in the industry as the lag effect, whereby crediting rates may continue to decline a bit more from here until enough of the new yield regime is represented in the portfolio to help offset those losses. I'll also say that one stable value asset class that has performed really well has been traditional GICs. Rates on these contracts follow treasury rates and therefore have increased dramatically this year, now being offered at levels that we last saw in 2018. 5-year GIC rates ended 2021 at 1.8% and now are a little bit above 4%, so quite a jump. And one of the benefits of these assets is that once a contract is purchased, there is no movement in their underlying value if rates or corporate spreads move. They're always held at par plus accrued and pay par plus accrued. Therefore, they've provided a better absolute return and some stability to managers that utilize this important asset class. And finally, obviously cash assets are at some point yielding now above 0% following the first 2 rate hikes. Money market funds are yielding anywhere between 20 and 40 basis points net of fees.
No, that's great. Thanks, Steve, for giving an overview of how the market environment is impacting the different types of stable value investment options. So just given the environment we're currently in, I think it's also very timely to talk about a key risk in stable value that isn't often discussed, which we at Putnam define as withdrawal risk. So can you discuss why withdrawal risk is so important, in the context of stable value?
Yeah, it's something that we think a lot about today, and actually the thing that leads us to the crux of our discussion on this webinar. Withdrawal risk, as detailed on page 2 of the presentation, is defined as the probability that stable value managers will need to sell assets within their wrap strategies to fund redemptions, specifically when the market to book ratio is below 100%. Combating this risk is very important, as no manager can correctly predict when their fund will receive or lose cash, as participants are sometimes fickle in their investment decision-making. Importantly, withdrawal risk is much more prevalent and detrimental during periods of rising interest rates, which we are clearly now in for the foreseeable future. This is because a lot of the underlying assets held in these portfolios will be trading below par during these periods, potentially carrying a loss on the investment from the original purchase price. Now, I want to clarify why we believe the current environment is somewhat unique with respect to withdrawal risk and therefore more dangerous than usual. As a group, stable value funds have been receiving inflow from participants really since the beginning of the COVID crisis, which roughly started in mid-March of 2020. Again, using our fund as a proxy, we have seen positive participant flow for 23 of the past 26 months. Both the aggregate dollar amount and the sheer number of consecutive months of inflow is really unprecedented and very different from every other crisis period in the past. In all the other crisis periods that we've looked at, and these include the long-term capital management crisis in '98, Y2K, the great financial crisis, of course, in 2008, and even the taper tantrum in 2013, assets quickly flowed back out of stable value funds after equity markets, specifically equity markets, calmed down. Now, this hasn't happened so far, even though these risk assets are still trading well above where they were pre-COVID, with all major indices still at least 10% higher, despite the recent market losses that we've seen from the peak. What that means is that there's now an enormous amount of money invested in stable value that will likely be redeployed into riskier options once equities find their bottom. After all, even the least educated of participants understand that investing solely in stable value is clearly not the way to meet their long-term retirement needs. Most importantly, if equity markets do happen to find their new bottom before the Fed is done raising interest rates, then stable value funds could easily turn cash flow negative at a time when the market to book ratio of these funds remains below 100%. Now, we've discussed absolute returns in the market year to date, so let's do some simple math that details what this metric might look like currently. The average market to book ratio of pooled funds at year-end 2021 was 101%, and the average duration of those funds was roughly 3 years across the industry. If we make the assumption that duration has remained 3 years in those funds, what this means is that the market value of underlying assets in wrap strategies has declined by an average of 525 basis points through Friday, as yields on 3-year duration treasuries are up roughly 175 basis points year to date. Therefore, this simple math would suggest that average market to book ratios in the industry are now roughly 96% on or below on most funds. Now, you might be sitting there asking, why does that matter? Well, the main reason is that most stable value funds do not have scheduled liquidity built into their structure, other than the cash that they hold. And that liquidity is there to protect them from having to sell assets to cover withdrawals for participants. Just to give some averages again, the average stable value fund today is roughly 96% invested in synthetic or wrapped assets with a 4% cash buffer. Therefore, all that would really need to happen would be 1 to 2 consecutive quarters of 2% plus withdrawals for most managers to deplete their cash and be forced to sell assets to fund any additional participant outflow. Again, using our fund as a proxy, since the end of 2007, we have seen 63 rolling 3-month periods of negative cash flow, roughly 37% of the time since 2007. And 21 of those periods have had negative cash flow of at least 2%. Now, given the unique circumstances of the current environment previously mentioned, mostly that we've seen huge flows in for a very long period of time, in our opinion, it is not at all unlikely that multiple quarters in a row of more than 2% cash flow out could happen. So for illustrative purposes, let's review how this level of outflow may affect stable value funds. On page 3 of the presentation, what we're showing here is a hypothetical example comparing 2 stable value funds. Each fund starts with a gross crediting rate of 2%, a duration of 3 years, and a market to book ratio of 100%. These are things that we consider reasonable starting points for January 1st of this year across the industry. Portfolio A has scheduled liquidity built into its structure, while Portfolio B simply relies on its cash for liquidity. The graph shows what happens to each fund's respective crediting rate under a scenario where the Fed raises rates 25 basis points for 5 straight quarters, and each portfolio experiences 2% withdrawals per quarter over that same period. Now, what I might also mention here is that we've already seen the Fed do 50 basis points once, and the market is anticipating they're going to do 50 basis points not only in June, but also in July. So the numbers that you see here, or the gap that you see here, is going to be even more pronounced if that actually comes to fruition. What the result is in the example on the far right bottom of the graph is that Portfolio B's crediting rate ends up 25 basis points lower than Portfolio A's at the end of 5 quarters. And the difference is that Portfolio A's liquidity structure was able to handle all of the withdrawals in each quarter, while after 2 quarters, portfolio B ran out of cash and had to begin selling wrapped assets that were now trading below par to satisfy those additional participant transfers. This 25 basis point crediting rate gap is a significant difference, as if you were to look at the current gap between a median manager and a top quartile manager in the Morningstar universe over 1 year, that gap was 36 basis points as of March 31st. So you can see how losing 25 plus basis points over 5 quarters relative to another manager would be a really huge hit to performance overall. The main point that we're trying to make here is that we don't believe that most managers have structured their stable value funds to be prepared for the risk of withdrawal that may be coming. Therefore, what you may see is some of their crediting rates may continue to fall for extended periods, even though interest rates continue to rise. Additionally, and the folks on the phone already know this as they utilize our fund, and Stacy mentioned it in the opening, we also believe that building long-term liquidity into a stable value fund, as well as structuring the withdrawal order to protect assets that are interest rate and spread move sensitive, which are the wrap strategies, from withdrawal activity can shield investors from this risk and increase the likelihood that a fund will provide stable and consistent returns over pretty much all market environments.
Great, thanks, Steve. I think that's a really good overview of why we think withdrawal risk is so important. I think the example that's shown on the screen here does a really good job of illustrating the importance of fund structure and how it can impact the return experience for a stable value investor depending on the structure of the portfolio. So just given the importance around fund structure, can you elaborate on how our fund is structured and touch upon how our structure may, over long periods of time, provide more stability in the market to book ratio? And on top of that, it'd be helpful if you could also explain how our built-in liquidity gives us the ability to track interest rates in a closer manner.
Sure. So as you mentioned, Putnam Stable Value Fund, or as Stacy mentioned in her opening comments, we're structured first and foremost to ensure that we always have adequate liquidity to handle all participant activity as well as a lot of plan activity in cash. And Stacy, if you move ahead to page 4, what this will graphically show is our liquidity structure, which is in addition to our cash holdings. The goal of this ladder is to provide us with at least 1.5% to 3% of the total portfolio value in maturities at par every quarter to help us handle outflows if participants decide to reallocate away from stable value, or we have plans that for whatever reason want to leave the fund to move to another vehicle. Compared to the average manager, who, as I mentioned, holds 4% cash as their sole liquidity buffer, we currently have over 30% of our portfolio dedicated to this particular task. And the great thing is that if assets mature and we don't need that cash for whatever reason, inflows are coming in or we're getting new plans coming in, we simply deploy it at the back end of the graph, which is the far right side of the page. As we know that we have a similar amount coming due the next quarter. If you look at the graph specifically, we have almost $400 million coming due this quarter in June, but also a very similar amount in September and even more than that for the remainder of the quarters that you see. So having assets mature at par is important as it does not affect your market to book ratio in any way. Secondly, and this goes to your question, Kevin, about tracking interest rates, it allows us to capture higher rates more quickly and in a cleaner way, as we do not have to sell any assets that we already hold in the portfolio to buy new securities, which are part of the new rate regime. This allows us to follow current interest rates with less of a lag than other managers, while still providing the stability of returns participants have come to expect in the stable value option. Now, conversely, anytime you sell something inside a wrapped strategy, the gain or loss from that sale is now realized. And that's a very important thing because it will affect crediting rates in the future. Obviously, this can be a positive thing when securities are trading at a premium and the market to book ratio of the strategy is over 100%. Right now, as I mentioned, most of, if not all, legacy assets in synthetic portfolios are trading below par because of the large interest rate rise that we've seen this year. And additionally, as no one can really predict participant behavior with any kind of foresight, the timing of liquidity-based sales is by definition uncertain. And over time, if you do that often enough within a synthetic strategy, it will affect your ability as a manager to structure and manage those portfolios in an optimal manner, which really should be for total return to the fund. And finally, we have actually layered our withdrawal orders on page 5, if you move forward, Stacy, so that the strategies with no sensitivity to interest rate moves are accessed for withdrawal first. And those are on this page, the tier 1 cash holdings that we have and the entire tier 2, which is our traditional GIC ladder. These strategies are in front of the strategies that are sensitive to rate moves. And just to reiterate, the value of traditional GICs and cash do not move when interest rates move up or down. And therefore, they are ideal to handle withdrawal requests. Additionally, if you look at the graph on the page, the third tier in our withdrawal order is the lower duration synthetic strategy in our fund, roughly 2.5 years. So that the last strategy to be accessed for participant activity is behind everything else, what we call tier 4, which has a duration of 4.5 years. So effectively, we're structuring the withdrawal order in the manner that protects the one strategy that has the most sensitivity to interest rates, so that frankly, we don't ever get there in terms of needing to access it for withdrawals. And lastly, I'll proudly say that in our history, and this goes back to 1991, we have never taken a withdrawal from a wrap contract or wrapped assets for any reason. Our liquidity structure that we showed you on the previous page has been more than sufficient to handle all our cash flow needs, not only at the participant level, but as most of you know, at the plan level as well, as we rarely utilize the 12-month put.
No, that's really helpful. Thanks, Steve. Just to kind of summarize, I think some of the key differentiators in terms of our fund structures, first, our keen focus on liquidity, shown by the liquidity ladder on the previous slide, how we have assets maturing at par on an ongoing basis. Secondly is the fact that we do utilize the full landscape of stable value investment options. As you can see, we have a structural allocation to cash, traditional GICs, and also 2 unique synthetic or wrapped strategies. And lastly, as you mentioned, the withdrawal hierarchy of our portfolio, as you mentioned, protects the more interest rate sensitive strategies, so we don't have to access wrap contracts, particularly during inopportune times, because that can create a more volatile future return experience for the investors in the portfolio. So thank you for that. So I think the last question I wanted to ask you, Steve, just given the challenging environment we're currently in, how are you currently managing the portfolio?
Yeah, it's a good question. Again, as I mentioned at the top of it, it's been a difficult market to navigate, and we actually have done a few things and modified a few things recently within the fund. First, and this shouldn't come as a surprise, we're paying very close attention to our liquidity structure to ensure that we're comfortable with the amount of maturing assets that we have coming due each quarter, and also, watching that in conjunction with the cash levels that we have. Again, as we can't really know if and when equities will bottom and if and when that may trigger outflow, it's very important to make sure that we're extremely comfortable with our liquidity position in this type of market. Secondly, we have recently been taking advantage of the better returns being offered in the traditional GIC market. And I'll harken back that there was a time from late March through early 2021 where we literally purchased no GICs at all because the rates were simply not competitive. As I mentioned, this particular asset class follows treasury rates very closely. And therefore, when those rates rallied dramatically when the COVID crisis hit, the GIC rates followed those down to very low levels. However, since that time, we've placed roughly $1.4 billion in GICs, around 9% of our, the total value, to backfill the ladder that we saw on page 4 to more appropriate levels and at better absolute rates than we would have gotten if we just automatically purchased GICs along the way, as a standard strategy. And thirdly, we've been running both of our synthetic strategies, the tier 3 and tier 4 you see on the page here, slightly short in duration to their benchmarks because of the rate moves up, which has been a modest help in terms of mitigating a little bit of the market value losses that we've seen in those strategies. And the final thing I'll mention is that we've been consciously shifting the sector mix in our wrap strategies slightly away from corporate credit in favor of mortgage securities, both pass-throughs and other mortgage credit securities, which are now offering more attractive spreads with less overall duration risk, which we think is a good combination in this particular market. And so I'll conclude that, while the environment has been quite challenging, we do believe that our fund has held up really well. As Stacy mentioned, we've maintained our long-term performance ranking in the Morningstar universe of pooled funds, as well as sustained one of the higher crediting rates in the industry, at least through the last time that we were able to see competitors, which was March 31st.
Great. Thanks so much, Steve. I think that was a really good overview just in terms of what's happening in the fixed income markets, talking about the effect of rising rates on various stable value investment options, and just giving a good refresher in terms of how our fund is structured and how we're currently positioned given the market environment. So just in terms of some Q&As, we received a question at the beginning of our conversation that I was hoping you can address, more talking about the different types of stable value options within a plan. So we know we're talking about, in this context, a stable value fund like the Putnam Stable Value Fund, but there are also, insurance company products or otherwise known as fixed accounts. So can you just touch upon briefly the differences between a stable value fund like Putnam's and an insurance-based stable value product or fixed account?
Yeah, so it's a great question, and it's one that we see a lot from a lot of different folks, because there are, in my opinion, major differences between those two types of vehicles. A fixed account is one that is basically an account that is issued from one insurance company. So depending upon who that is, they will offer you a fixed rate of return for a period of time, and that rate will change over time as the fund moves along. Sometimes that changes quarterly, sometimes it's semi-annually, sometimes it's annual. But effectively, the insurance company sets the rate on the contract for the next period of time based on a very, I would call it archaic formula in their contract. It's not something you can observe. And the biggest difference in the products is that your assets, when you go into a product like that, are backed by one company. So really, it's the credit worthiness and not only the ability, but the willingness of that one company to pay their liabilities that basically makes that product kind of putting all your eggs in one basket. So, from our perspective, regardless of how attractive the credit quality is of that one institution, you are taking very specific credit risk with that one insurer, who also will be setting that crediting rate based on metrics that you won't be able to observe. When you move to a product like our stable value fund, there's a couple differences. One, we deliver you the return that the market delivers to us. So there's no hocus pocus in the formula. When we return something on the portfolio, that goes directly to participants minus fees. So it's a much more observable rate that you can guarantee what the changes will be going forward. The second and maybe more important difference when we're talking about 401k assets is that we diversify our risk among many different issuers. So, and I'm not saying we don't have any credit risk in the portfolio, because clearly that we do, but we utilize 11 to 12 different issuers on the wrap and GIC side that spreads that specific risk across different names, so that if there happened to be one problem with any one insurance provider, it's not the entire portfolio that's caught up in that particular credit issue. So we would consider that to be a more appropriate way to diversify risk, specifically in a 401k type product. And also, because the returns are much more market-based, there's no way for us to game the system, or at least change that crediting rate that can be done on a fixed account without really being able to explain to the plan sponsor exactly why that happened.
Great. Thanks, Steve. I think that was a really helpful overview to just discuss the differentiators between the two. So we received another question around if there's a report that can show cash levels for a stable value fund, or determine the percentage of traditional GICs in a portfolio. And I'll just comment that here at Putnam, we have a number of marketing materials or a website that provides an update, at least on a quarterly basis, that shows the breakdown of assets within our portfolio. So it will show the percentage of the fund invested in cash, percentage of the fund invested in traditional GICs, and the percentage of the fund invested within our 2 underlying synthetic strategies. So the cylinder graph that you see here on the slide, on a quarterly basis, we will show the percentage of the fund that's invested in each of the 4 tiers. So we do have that information readily available, again, on a quarterly basis. So I think that's all the Q&A that we received. So I just want to say thanks again for everyone's time. Really appreciate the continued partnership, and we hope you found this conversation helpful in terms of an update on what's happening within stable value. And with that, I'll pass it back to Stacy.
Yes, thanks, Kevin. Thanks, Steve. I really enjoyed the conversation and appreciate your time today. Thank you for all of the questions. As mentioned, the RPAG support team can help address questions on this strategy, as well as the Putnam DCIO team. We're happy to share our contact information afterwards. Just a quick note on resources, and thanks to Kevin for pointing out, you can find a variety of information on the Putnam DCIO website, putnam.com/DCIO. You can read all about our stable value strategy. And then the RPAG Stable Value CIT fact sheet is available through Wilmington Trust and breaks down the strategy in a variety of ways. And then, of course, as I mentioned earlier, the RPAG tool suite does offer a stable value analyzer tool. So you're able to find much of this data and information on the strategy there as well. Again, thank you for your time. We appreciate the support and the partnership that Putnam Investments enjoys with RPAG. We hope you all have a wonderful day. I see Leah's popped back on. Don't know if she has any final words as she closes out this webinar, but we thank you for your time.
Thank you so much, Stacy. Kind of just to reiterate what she said, if you have any questions that come up after this webinar, feel free to contact the support team, support@rpag.com if you don't already know it, and we'll be able to assist you further with any of your questions. But thank you so much, Stacy, Steve, Kevin, for your time today. Thank you for taking time to speak to the RPAG members today. We really appreciate it. So thank you so much, and I hope everyone has a great day.